Bernanke signals no further stimulus is likely. Is that true?
Well, he didn't remove it from the table. I think what that article intended to say was that there's no further stimulus likely in June at the next meeting. Now, that's clearly, I think, the case. What I saw from the Fed yesterday was they expressed a growing confidence in the nascent economic expansion. However, Bernanke was very careful to note the substantial economic headwinds still out there, which is why he went out of his way in the Q&A period to say that more asset purchases are not off the table should economic conditions deteriorate.
Oh, you're saying not until June, right?
No,
but
no,
Operation Twist is going to expire at the end of June, but then there will be elections, and many people say that there will not be any stimulus after the elections. If he does anything, he should be doing it before the elections. Do you agree?
Well, I'm sure that there's a certain number of people on one side of the political spectrum who would like that.
Right.
My sense of this is that if the Fed acts before the election, it will have to do with the condition of the U.S. banking system due to an intensification of the sovereign debt crisis in Europe. And let me explain. Should problems in Spain spit out of control and we begin to see funding pressures at the short end of the market, the Fed may need to move to act. Now, that doesn't necessarily mean they're going to purchase assets. The Fed could simply reinstate its credit easing programs that are meant to provide ample liquidity and ensure that there's not an overnight funding crisis which could harm a bank or other banks. So the Fed has a number of tools at its disposal in addition to asset purchase to respond to any exigent circumstance that would arise from the situation in Europe. Now, with respect to asset purchases, I think that if it happens, it's for two reasons. One is we get a good 3-month to 6-month run of very weak economic data. Or two, inflation expectations begin to fall back and the market professionals and the public began pricing in a period of disinflation or outright deflation. I'm fairly certain that if the Fed sees that, they'd act forthrightly, regardless of when the election is.
Let's talk about another tool that Fed uses, the interest rates. You know, we know that Jeffrey Lacker always refuses the idea of keeping the interest rates low until the end of 2014. He wants it higher in 2013, actually even before.
Well, Jeffrey Lacker, who's dissented 3 times in a row now,
right?
Would prefer the beginning of what we call the normalization of rate policy start in 2013. Now, when you take a look at the committee, right, what you saw was at least 2 members, at least not just the committee, but the larger Federal Reserve, changed their rate preferences from, say, normalization in 2016 to either 2015 or 2014. So while Lacker has dissented consistently, the sort of what I would call the consensus within the committee hasn't changed. That the first rate hike, whenever that is, it looks like it would be in late 2014. That's a long time away.
And do you agree with him or with the rest of the committee?
Well, my sense of this is that the economic headwinds are fairly significant, that we're 5.3 million jobs short of full employment. We have a 5.5% output gap. Financial conditions, both in the United States and in Europe, are tightening since April 3rd, and that has to do with the situation in Europe. And to be perfectly blunt, we still haven't repaired the hole in the financial system here in the United States. While commercial and industrial loans are up and total private credit creations really did jump in an impressive way in the 4th quarter of last year, our asset-backed securities market just has not recovered. So the Fed still has, I think, from their point of view, a lot of heavy lifting to do before they begin the normalization of rate policy. And if I may say, I think the big risk here also is a policy error of premature tightening both on the fiscal side and the monetary side. So no, I don't think we're going to see any moves to tighten rates out of the Fed, and probably until the last quarter of 2014.
Joseph, from the picture that you just described us, it looks like you do not agree with the growth projection of Fed that he just announced yesterday, because he increased, the Fed increased the growth for next year, but not so much the following year. And how about the unemployment and inflation targets, that they were all changed? How should we interpret these numbers?
Okay, well, one thing on the growth, the Fed's still mildly optimistic on growth. They're expecting around 2.7%. I think a little less than 2.5% this year. So not that much of a difference. Now, I do agree with the downgrade next year. We do have what we call an impending fiscal cliff that the economy may hit due to the expiration of the Obama tax holidays, the Bush tax cuts, the start of tax hikes to support Obamacare. These things are all going to happen at the beginning of next year, and if the Congress doesn't act, that could harm overall growth prospects. And with respect to employment, the unemployment rate is falling, but it's falling very gradually. And we have some very unusual seasonal patterns here in the United States due to the shock in 2007 and 2008, which Bernanke actually went out of his way to note in the Q&A session yesterday. So it is possible that the unemployment rate may jump back up even to 8.5% here over the next couple months. There's really no difference from an economic point of view between an unemployment rate of 8 and 8.5%. That's more important in terms of maybe the presidential election, or even 7.8.
You do not think it is that significant?
No, I don't think it's that significant. That has more to do with reporting on the presidential election, and that's a different story. The Fed's keeping its eye on the prize, which is full employment. That's where the Fed wants to get back to, and most economists will agree that's where the economy is going to have to get back to for us to really begin to fully heal. Now, with respect to the inflation numbers, yes, inflation is going to be a bit higher this year, and that has to do with volatility in energy and commodity prices. But remember, we've seen this over the past 3 years, and they prove transitory. They go up, aggregate demand slows down, and then inflation falls in its wake.
So it's temporary, you're saying, and it's related to maybe increasing oil prices?
Yeah, oil is the big culprit here.
And let's talk about today's jobless claims. Well, more Americans than projected filed jobless claims last week again. Well, how should we read this?
That plays right into what we were just talking about. The U.S. economy's had this very unusual pattern over the last 3 years following that 7 standard deviation shock that it experienced in 2008 and 2007, 2008. Essentially what's happening is the economy, the data tends to improve in the last quarter of each year and the first quarter of each year, then moves sideways early in the spring, and then begins to deteriorate. That's exactly the pattern we're seeing in jobless claims. Improve early in the year, move sideways in March, and then begin to fall in April. So what it means is the non-farm payrolls report for April, which is going to be released next Friday, is likely to be closer to 100,000 than 200,000. And remember, over the last 3 months, we've seen growth roughly at 212,000. So that would be, I think, a disappointment to global investors.
Because they changed the whole unemployment rate depending on the first quarter non-farm payroll, right? That's what they told. Actually, it was reported for the first quarter, the non-farm payroll kept coming over 200,000. So you're expecting 100,000?
Closer to 100,000. Remember, we had 120,000
This is an important projection. Thank you for sharing with us. So you're still on the bearish side as I see it.
Well, I think that it's what the data is telling us. We're going to grow at roughly 2%. We're not going to fall into recession. This is the economy we have. We have a 2% economy. And, you know, policymakers in a crisis, and have no doubt, the global financial crisis isn't over. Policymakers have to shape policy for the economy they have, not the one they desire. And in a crisis, they should err on doing more rather than doing less. And I think over the next year, that's what's likely to happen.
Thank you so much for joining us and sharing this very valuable information.